Hello, I'm Noel Lim on ASEAN Speaks by Maybank. We look at the implications of US non-farm payrolls data and major currency movements in Asia, as well as the outlook on Malaysian banks, and follow the money of foreign investors. Yeow, Portfolio Strategies, discusses with the analysts.
Good morning, everybody, to the morning call. Now, with Friday's non-farm payrolls, the August jobs report shows that the Fed may still be able to achieve a soft landing. The 2-year USTs are off about 11 basis points from their highs of 352. And, this basically suggests that, the Fed now has more leeway to deciding between a 50 basis point and 75 basis point hike in the September FOMC meeting. Markets may get some reprieve, but if you look at the bigger picture, with CPI still running above 4%, the Fed funds rate, in theory, needs to be above 4% to tame inflation. With market pricing peak inflation at between 3.75 to 4%, will the 10-year UST retrace back to June's high of 350? And may this be the double top that could signal the end of the current bear market cycle? Let's go over to our panelists to talk to them about these issues. Suhaimi, let me bring you onto the call first. In the latest set of US non-farm payrolls, the participation rate of the prime age men and women both rose to the expansionary zone of 62. All of these indicators are very good, but tell us, why is the non-farm payrolls defying gravity, despite all the negative press that we are seeing, people, corporates laying off, etc., etc.? So, I mean,
hi, morning, Yeow. As to why NFP is defying gravity, job demands in services part of the economy, I guess, is still strong, with 70% of the NFP gain in August driven by services activities like professional and business services, healthcare, retail and wholesale trade, financial services, as well as leisure and hospitality. I think, as you said, overall indicators are pointing to a still healthy US job market. But I think one set of data, in this case the job market stats, is unlikely to thoroughly settle the debate whether Fed will raise interest rate by another round of 75 basis point or ease the pace of rate hike to 50 basis point at the next FOMC. All eyes will be on the next key data for the 21st September FOMC, which is, I think, inflation numbers that will be released on 13th of September. So I think for the upcoming August CPI, and in view of the latest job market indicators, the consensus is looking at minus 0.1% month-on-month drop after a flat July, implying year-on-year inflation rate to ease further to 8.2% last month from 8.5% the month before.
Let me ask you on this point then. With the general trends of inflation coming off quite nicely, do you foresee a scenario where the CPI actually hits back up?
I think based on the June San Francisco Fed study, it found that supply factors are responsible for half of the difference between current and pre-pandemic inflation. Demand drivers account for only around 1/3 of the run-up in inflation. The remainder resulting from ambiguous factors that I guess cannot really be specifically labeled as demand or supply-driven factors. So I think this implies that US inflationary pressures will not subside merely or solely on Fed tightening, because monetary policy will only affect demand. So I think inflation path or scenario will also be dependent on how supply and other factors like how global supply chain, how US labor market, and how even geopolitics going to evolve in coming months. So I think these are going to be factors that are going to tell us or show us whether there is going to be upside or downside risk to US inflation going forward.
Okay, so sounds like there's still a lot of uncertainties out there, and only time will tell when the clouds will actually clear. Let's go over to the credit markets right now. Winson, Do you think the markets are wrong about the 3.75% pricing for peak Fed funds rate?
I think a peak Fed funds rate of 3.75 to 4%, it seems fair, because to reach this range, it only require another 150 bp total hike. For example, 75 bp in September, 50 bp in November, another 25 bp in December. That seems fair because the US labor market condition is still very tight. US inflation, so Amy mentioned just now, is still very high. So at the moment, the Fed doesn't seem to have any other option but to keep hiking rate and continue to guide with hawkish forward guidance. And as we can see at the Jackson Hole Forum, Chair Powell mentioned about the lesson from the successful Volcker disinflation period in the early 1980s, using restrictive monetary policy by controversially hiking interest rate to as high as 20% at one point. But I think what we need to be cautious about is what Chair Powell didn't mention was that the highly restrictive monetary policy that time also brought two recessions to the US within the first 3 years of Paul Walker as Fed chair. So 2 recessions in 3 years. So even though I think 3.75 and 4% Fed funds rate is fair, but in a highly uncertain macro environment, forward guidance has very short shelf life. It can change within 1 to 2 months or 3 months. And as we can see from the peak Fed funds rate, the market pricing, it actually swing quite wildly. At one point in June, above 4% peak Fed funds rate. In August, at one point, it fell to 3%, and now is about 3.8%. So we'll watch for continued volatility.
Okay, so naturally with this backdrop and the likelihood of a recession, be it a hard one or soft one, you expect the US 2-year and 10-year curve to actually stay deeply inverted for a period of time. And the point you made in your last report is that you don't think the 10-year will rise too far from 3%. So at what range then do you think the 10-year will likely settle at? Would you walk us through your thought processes, please?
Yeah, I think 3.5% 10-year US yield reach in June. That is probably the peak yield this year, and also probably the peak yield in this cycle. The Fed can hike rate all the way to 4% in combination with quantitative tightening or so-called balance sheet reductions. But the chances of recession in this kind of environment can be high. And this can actually raise heaven demand for US Treasury, therefore keeping the long end yield better anchored, and therefore the curve deeply inverted. So for 2-year and 10-year, the Treasury curve, I think it can stay inverted until a dovish pivot by the Fed. And if you look at the other part of the curve, like the 3-month and 10-year, I think some market participants or even the regional Fed, they use some models to estimate the probability of a recession in the US. But I would say 3-month 10-year in this kind of fast tightening cycle is probably a lagging indicator to a 2-year and 10-year. And I expect a 3-month 10-year to start inverting within 1 or 2 months from now. The other part of the curve I think would be interesting to look at is actually the 3-month 2-year. The 3-month 2-year actually is a signal on imminent or potential rate cut ahead. So once this part of the curve invert, it could actually signal a dovish pivot by the Fed pretty soon.
Thanks. That's very interesting. Let's bring this back to Asia. Especially for the benefit of our bankers here in Singapore and Malaysia. Would you buy the 10-year SGS or the 10-year MGS, especially in light of Malaysia G15?
I think Singapore 10-year SGS yield at a level of 3% or higher. I think this is a good level for investor to scale in gradually because of the US rates view we mentioned earlier. On Malaysia, Ringgit government bond is an outperformer this year because it managed to post a small positive return, total return, In comparison with global aggregate and also US Treasuries, these two indices are actually showing a negative return of more than 10% on a year-to-date basis. So you can see ringgit government bonds actually has performed quite well. We maintain that late cycle dynamics will drive a 10-year MGS yield to 3.75% within the next 3 to 6 months, although I have to say this is a non-consensus view. So unless there is a major negative surprise from Malaysia GE15, the elections, otherwise I think the bond yield will continue to be influenced more by domestic and global macroeconomic settings.
Okay, great. Thanks for that. Let's go to the FX desk at this moment. And last week's key development must have been the yen. It's broken 140. Andy, you know, with Japan rarely intervenes in the currency market, save for, if I recall, only 2 occasions. One was the 2011 Fukushima crisis, and then, of course, in the Asian financial crisis, 97, 98. Do you think it will intervene this time round? And what would that threshold be?
Morning, Yeow. I think this time round it's a bit unique compared to Fukushima crisis and Asian financial crisis. It's not we haven't seen it majorly affected, largely because, of course, policy on the BOJ front. On the possibility of FX intervention, we note that officials from the BOJ, the Ministry of Finance and the Financial Services Agency actually met in mid-June after the yen actually saw a significant bout of softening. And they released in a joint statement, expressed their concern about the sudden weakening of the yen, saying that they will take action if necessary. So indeed, there will be a risk of intervention, especially if it's gone over 140. At the moment, it's currently about 140 and 42. So risk of direct intervention by authorities is definitely higher now. Definitely will help keep dollar yen resist upswings towards the 145 levels or so if it goes above 140 for a sustained period, but it's already broken the 140 threshold level. So our sense is, I think it would be hard for them to intervene in a very sustained manner without actually affecting their reserves in a big significant way. Our view is, I think we see scope for a strong downward bias in the dollar yen eventually towards the end of the year into 2023. So it all depends on the US policy side and also on the growth numbers coming out earlier than expected. Seng.
How much would the euro play in this scheme of things then? I mean, euro is at parity with the dollar at the moment.
Yes.
Do you think the losses will continue?
Very important question there. The key currencies that we look out for will be on the euro front, on the eurozone and euro front, as well as on the US front and China. So these 3 key hegemons are something that we want to look out for. But taken together, for the euro front, increasing challenging economic situation, I think notwithstanding the adequate gas storage for winter, apparently there's signs that they have actually accumulated more than what they need for now. There's still lingering political risk in Italy and potential hurdles for a decisive monetary action from the ECB. All that could continue to weigh on the euro in the near term. That is why we think euro will probably end this year below parity, around the 99 cents. And a low of around probably 0.98 or lower in the third quarter. There's some upside risk to euro, but I think in terms of war in Ukraine, showing signs of abating, the probability seems quite low. Second, ECB catching up on policy normalization. For example, if they move 75 basis points, that would definitely have some support for the euro. And finally, on the eurozone growth momentum. Even so far, though, it may be impacted but not derailed somewhat in terms of growth momentum there. So we'll see if there's any positive indication of growth momentum from data. It could actually have some support on the euro front in totality for euro as well.
Okay.
Yeah.
Well, let's then let me ask you one final question on Asia FX then. Obviously, the currencies here will not be immune to that secular shift, right? Everybody is weakening. What are your thoughts on the ringgit breaking 450 then?
Yeah, but ringgit breaking 450, I think it's not easy to rule out. It's already at 448 and reach a high of 449. So our view is I think ringgit weakness will continue because of the drive by various exogenous factors. The US dollar strength will be definitely will continue like we said before, and I think the sharp and continued decline in the renminbi, which ringgit has a strong correlation to, and we have actually revised our renminbi forecast towards 7, revised from about 675, 680 levels, which was previously for the third quarter. I think the risk of China slowdown, extended lockdowns, ongoing war in Ukraine, and concerns about upcoming GE or general elections in Malaysia, all that typically would lead to volatility. If you add all that up with global growth and risk aversion supporting the dollar, I think cautious view of risky assets, which includes the ringgit. We think that the ringgit could test the 450 level or remain range bound around the 445 to 455 range. It will possibly break 450 soon, especially if dollar strengthens. So our view is for the end of the year, ringgit could still possibly end the year around 450.
Okay,
Yeah.
thanks.
Yeah.
Interesting point you made about the renminbi, and I think Bloomberg has also written an article last week agreeing with you that they're probably happy to let the yuan slip past 7. But I guess the bigger question is, with the PMI now in contractionary range under 50, and we have all these Sichuan power rationing and the slowdown in the G2 orders and all this in a backdrop. Do you think the Chinese government will intervene? Right? It's basically the broader question here.
Yeah, I think in terms of, I think if you back to your question, I think if you rephrase it to the fact that maybe whether you're asking whether there'll be a devaluation, I don't think a devaluation is of high probability now. What they've done is they have revised, they've actually taken consecutive days of stronger yuan fix, especially into the end of August. So trying to give a strong signal for PBOC to slow the yuan depreciation. And PBOC's next move could be to lower the forex required reserve ratio in order to boost dollar supply and prop up the yen. So I don't think there will be a massive devaluation, but those are the efforts that probably the yen, the PBOC and China could take to actually support the yuan. In the end, I think for China's case, it's about the zero COVID strategy. It's also about their shift away from the easing policy that they've taken, plus all the property domestic situation. But so they can't fight the macro story onshore in domestically, plus they can't fight the dollar appreciation if you're talking about renminbi against the dollar. So I think it's going to be hard for them to sort of defend the currency in some ways. So the devaluation for now is low probability, but yes, if it sort of worsens, the zero COVID extends beyond this year, after the CCP conference, there is a higher probability of the devaluation coming on stream after November, in my view. Thanks.
Excellent insights. Thanks, Andy. Let's head over to Thailand and Philippines right now. I'll bring on the economists. Julia, Thailand's current account deficit actually deteriorated to 4 billion in July. Previously, I think it was at the 1 billion mark. This number already factors in an improvement in the upward revision in tourist arrivals, which kind of doubled in August. But then the trade deficit was the culprit here. It kind of eased all the way to 17-month low of 4%. And the Commerce Ministry basically blamed this on China's lockdown. Do you think the deficit has further downside? Because obviously this will have a bearing in terms of how much or how vulnerable the part will be. Julia?
Yeah, hi. Morning, everyone. Indeed, the weak exports was both due to China's lockdowns as well as weaker global demand. And alongside this, the surging imports because of high energy prices, given that Thailand is a net oil importer, have both weakened the current account balance. And on a balance of payment basis, the goods trade balance swung to a deficit of around $0.4 billion compared to the surplus of $2 billion in June, and that's the first goods trade deficit since January 2019. This resulted in the current account deficit widening in July to $4.1 billion. And it's also extending the very weak performance in the second quarter, where current account deficit came in at 7% of GDP. But we think the worst for the current account balance should be over. Oil prices are easing, and the recovery in tourism is gaining momentum. In fact, in August, tourist arrivals rose further to 1.4 million, and the government is aiming for a total of 10 million for the full year. And we estimate that every 4 million tourists adds to around 1% of GDP in terms of tourism revenue to the current account. And we do, while for the full year for this 2022, we would still expect the current account deficit, the current account to come into a deficit of around 2.2% of GDP. We do expect the balance to turn to a surplus in 2023. By then, the government is expecting tourist arrivals to climb to 30 million, which is around 3/4 of pre-pandemic levels.
Okay, so all hinges on the tourism arrivals, and if a new variant breaks out, touch wood, all bets are off from the sounds of it.
That's right.
Okay. Zamros, can I bring you in on Philippines, please? The current account of Philippines also doesn't look particularly strong for the country. Do you think the peso can hold at 56? And what could set Philippines apart from Thailand?
Hi, morning, Seng Yeow. Morning, everyone. I think a few factors comes into play here. We're talking about current account of the Philippines. The first thing is of course, similar to Thailand, the trade deficit has been the culprit. Imports has been higher in the Philippines as compared to exports. Exports was affected by the weakening external demand, but imports has been higher because of the elevated commodity prices. And BSP themselves estimated that 2/3 of the deficits in the current account was due to the higher food and energy prices. And secondly, on the massive build programs by the government on the infrastructure projects. This was started in 2016 by the then former President Duterte. And looking from the input-output tables from the Philippines, it shows that the construction project has 35% import items in it. So that's going to continue to contribute to the trade deficits and current account deficits in the Philippines. But nevertheless, despite the infrastructure projects has a negative impact on the current account, these massive build infrastructure projects is important for the Philippines to be able to sustain growth over the long run. So yeah.
Sorry, can you give us an idea what the pipeline is? So build. If my memory serves me correct, it's about 120 so-called, projects in total, right? Where are we in that 120 at this moment, and what's the slack that is left?
The thing is, some of the projects has been completed, but we don't have the latest, detailed list of projects by the government. But for the new President Marcos continued with the policies by President Duterte, whereby at least 5%. The size of infrastructure projects will be about 5% of total GDP. So that's going to be huge going forward.
Okay.
So that's the first point on the trade deficits. And the balancing act will be coming from the overseas Filipino workers' remittances. I think we cannot underestimate the support by remittances on the current account. And looking from the trend in remittances over the years, we expect higher remittances in the fourth quarter of this year. And remittances makes about 20% share of the total current account credit for the Philippines. And if you look from the historical perspective, current account has been deficit for the Philippines before 2003, but it tilted to surplus from 2003 to 2015, mainly because of the change in the government policy, whereby in 2001, the government took a new stand regarding the migrant workers, whereby at that time it's actively promoting international labor migration as a growth strategy, especially for higher skilled and knowledge-based workers. So I think that's the two things, the trade deficit and the overseas remittances that comes into play in determining whether peso could hold at 56 against US dollar for the Philippines. Yeah.
Okay, great. So from sounds of it, it sounds like peso sounds weak, but in your view, could be the stability scenario could be there. Yeah.
Yeah.
Jacqui, could I bring you in for your quick thoughts on this now, in light of the peso, right? What is your top picks for the sectors that your research team is watching?
Hi, good morning. Yes. So exporters like mining companies will definitely be winners given its USD indexed revenues and predominantly peso-based costs. So the biggest one that we have here is a coal mining company called Semirara Mining. But some renewable energy power companies also have USD-based or USD indexed revenue streams, and they should benefit as well. And among those are actually ASEN and First Gen. So except for minor exposures to foreign currency debt, denominated debt, a weaker than expected peso should be neutral for the property, telco, retailing, and utility sectors, given their peso-based revenue and costs. And banks are also likely to be neutral, given that peso movement is really, the FX income is really flow-driven. The losers will definitely be the fast-moving consumer goods companies, mainly because of their predominantly peso-based revenues and sufficient natural hedge, given that up to 60% of their costs are actually imported raw materials, and the limited pricing power from its relatively elastic product portfolio. So among the most vulnerable in this team would definitely be Universal Robina Corporation, Century Pacific, and San Miguel Foods.
Great, thanks for that. Okay, last but not least, let's bring in the Malaysia research team. Desmond, if I can put the first question to you on the banking sector, because last week we did see some moves in banking stocks, and it was quite interesting, at least to me. From foreign shareholding perspective, we can tell from the Bloomberg statistics that they're not really in a big way for the Malaysian market just yet. But for Malaysia banks, that we're starting to see some signs of improvement. What's your outlook for the sector, and what might be your top picks for the banks?
Yeah, morning all. So essentially, the outlook for the banking sector is still cautious at this point ahead of slower economic growth into next year. But the main consolation for me is the fact that the fundamentals of the banks are still strong. In particular, I believe that the banks have built up sufficient provisions to weather through this economic volatility. So in my earnings forecasts, I've tried to be as prudent with the estimates as possible and kept credit cost assumptions fairly elevated into 2023 as well. Even then, I'm looking at aggregate earnings growth of about 18%, which is fairly decent. So my overweight on the sector is therefore largely premised on the expected expansion in ROEs and the fact that valuations are still looking pretty decent at this point in time. So the buys on my list would be CIMB, AMMB, Alliance Bank, Hong Leong Bank, and RHB.
Well, interesting pick on Hong Leong Bank. This bank has an 18% associate stake in Bank of Chengdu. And with all this lockdown and everything, what do you see in this in Hong Leong Bank? Is it pure valuation, or you think might be a situational play in that sense?
Yeah, well, Bank of Chengdu has been quite a major contributor to earnings growth of Hong Leong Bank as a group itself. Notwithstanding the fact that Hong Leong Bank's domestic operations have very strong fundamentals. At this point in time, given that Chengdu has gone into lockdown, today itself I've issued a note lowering the earnings for Bank of Chengdu, and also given the fact that they recognized the 240 million mark-to-market gain last quarter from convertible bonds in Bank of Chengdu, I've assumed that that reverses out as well. So I've lowered the earnings for Hong Leong Bank, but the valuations are still decent, which is why it's still a buy call at this stage.
Great stuff. Anand, if I could put the last question to you. What other sectors do you like from a foreign shareholding standpoint, especially in light of the impending G50?
Yeah, hi, good morning, Seng. Good morning, everyone. So I think, when you look at the foreign shareholding trends over the last 6 months in particular, we have seen some recovery in sectors like banks, as you've just pointed out, but some other sectors where there's been a very slow recovery in foreign shareholding, which we would think is an opportunity. I would flag two sectors. One is technology hardware. In line with the rest of the world, there's been a big sell-off in tech, and Malaysian tech stocks have also seen a lot of foreign selling. But recent results have been very robust in the sector, and we think the sector remains very investable, especially at these price levels. So stocks like Inari, Frontcan, Vitrox, which have seen big declines in foreign shareholding, definitely a space where we see a recovery in foreign interest on a 1 year to 18 months time frame. The other sector where we see foreign investors returning would be the international border reopening plays. So aviation transport like Capital A, MEHB, which are both on our buy list, should see a recovery in foreign interest. And the others would be something like gaming, Genting Malaysia, as well as healthcare, something like IHH, where you have foreign interests having sort of diminished over the last 24 months. But with improving fundamentals, they should return.
Okay, great. Thanks for that, Anand. Well, that's all the time we have for today. If there are any questions or queries regarding all of the names that we raised in today's call, please feel free to reach out, and we're more than happy to get back to you with the details. Enjoy the rest of the week, and I guess we'll see you at the next call. Thank you.
For more information, speak to your trading rep and download our reports at Maybank Trade app. Have a good week. I'm Noel Lim on ASEAN Speaks by Maybank.